Greetings to one and all watching this. My name is Valerina Clayton. I and my fellow colleague, Mr. Krishna Saraf, have with us a very special guest, Mr. Siddharth Rai Mangala. Mr. Siddharth is a certified financial risk manager awarded by the Global Association of Risk Professional, known as GARB. He has received numerous certifications from the National Institute of Securities Market on currency derivatives, equity derivatives, mutual fund, and research analyst. He is the founder of Sid Investing, where he prepares research reports on the financial markets and helps people manage their money and a lot more. It's a pleasure having you here, sir, with us. And we hope this interview is beneficial for us as well as all who's going to be watching it. So without any further delay, let's dive right into the interview. I would now like to call upon Krishna to take the interview forward.
Thank you, Valerina. So let's start. The first question which I want to ask is, could you tell us how important is financial management in current scenario?
Okay, so first of all, hi Valerina and hi Krishna. That was indeed a very impressive introduction. Yeah, so I was very, I was trying to stop myself from blushing, huh? So it was pretty good. Okay, so see Krishna, financial management basically means that you're taking care of your finances in the current times, and at the same time you are making sure that your future is secure financially. And it doesn't matter in which field you are working as a professional. You can be a doctor, you can be an engineer, you can be a CA, or either you can be into your own business, or you can be doing a government job. But if there is one thing which is common among all of us, and that is finance, that is money. And we must all know how to manage our money in such a way that we can live very comfortably, and at the same time we can prepare our future generations in such a way that they do not have to, they can only grow from where we, give them the opportunities to move ahead in their lives. So financial management is in fact very important.
Okay, great, sir. And sir, your views on financial health of the company, like the leverage, profitability, liquidity, and all, etc.
A good company, basically, a good company has to be, first of all, the biggest advantage a good company has is in its product. A company can be over leveraged for a very short period. It can be into trouble for some period. But if a company's core product is strong, then all those financial problems can be dealt with. Because that strong core product is a moat around the company. The other things definitely are that the company should look after its investors, first of all, who are the owners of the business. And a good company is the one which definitely maintains a few of the ratios, like the debt equity ratio and the interest coverage ratios, and they must take care of these ratios. They just sometimes companies try to only focus on the upcoming quarters, and that is not the right manner to function when you are managing a large pool of investors' money. You have to keep a vision of at least like 3 to 5 years. You have to keep a very long-term vision, and not just look at the upcoming quarters, so that the stock price keeps the investors morale boosted. So a good company is the one which looks after the interests of its investors, and which keeps a very long vision. I think you were expecting something, an answer which was related to some financial matrix, but
no, sir.
It is something. Yeah,
it's perfect.
It is something which I think is more important.
Yeah, that's good, sir. So my next question is: can a company with positive cash flow be in financial trouble?
Okay. See, to start with this answer, I'll tell you a quote. There's a very good quote in finance that making money from selling milk from your cow and making money from selling your cow are two different things. So yeah, you can be cash flow positive, but it doesn't matter as much as then you have to look into it, that where is the money coming from, where are the cash flows exactly coming from. Are these cash flows coming from your core product? Are these cash flows coming in because people are going to buy your product, and there is your market share is increasing and all those good things? Or these are coming from for some different reasons, that you're raising some debt, or you're trying to sell your businesses or stuff like that. So cash flow positive is just a number. I think you have to look into it to get a clear picture of the company, of what's happening.
Okay, sir. And next thing, I saw a lot of videos, like even in the YouTube as well as on the Instagram, that you actually suggest investing in stocks and other like commodities also. So I would just want to ask you, what do you prefer while investing, the money market or the capital market, and what's the reason behind of that?
See, it's not either of them is a good choice. It depends upon the investor who is investing his money. It depends upon his or her requirements. If you are a very risk-taking sort of a person, if you are a young person, who has a lot of time to see growth, then you should definitely be into capital markets, because you can give it time. You can give your equities or your companies in which you invest your money in, you can give them time to grow. If you're if you are 25 years old, you can give your company 30 years to show the kind of growth you're looking for. So capital markets is better for people who are young, who are in the early stages of their investing career, or who have a good risk taking appetite. But money markets money markets provide stability. Money markets provide a stable return, a secure return to their investors. So money markets are also not a bad instrument. We always try to compare these two things, but I think we should always look at them as complementaries to each other. We should keep both of them in our portfolios, and depending upon the stage at which we are in our lives, the proportion of money market instruments and capital markets instruments we should keep on increasing and decreasing them. So neither of them is bad or good. It depends upon us. Yeah.
So what do you prefer in general, sir?
For me, see, for me at the stage in which I am in my life, I will definitely prefer capital markets. But for somebody like my father or my grandfather, who do not want to take so many risks now, and at their stage of life, they just want to keep the money they have made throughout their lives secure, and they want a passive income on that. Money markets are better for them. Yeah, but we people love risks, and that is why we are into these markets. So we definitely prefer capital markets.
Great, sir, great. Now Valerina will continue.
Thank you, Krishna. So talking about risk, and I see you're a certified financial risk manager. Could you briefly explain to us what's the process of risk management? Like, how do you identify, the risk in a particular company, and after identification, how do you deal with it?
See, it's a very deep question, so I cannot go that deep into it. But I can tell you that risk management is it is not all about numbers. In the investment process, generally we first of all we look at analysis, research and analysis, and then we move towards the risk management part. But I think it should be, risk management should be the first step. We should look at the risks. That should be the first thing we should be looked in an investment. We should always be ready to go wrong in capital markets. If somebody who comes into the capital markets who thinks that he can only go right and he can only have a success rate of 100%, like I buy 10 stocks and they all have to go up, then I can never make a big impact in those capital markets. I always have to be keeping the risks in my mind. So the risks, the risks, the quantifiable risks, these are very common things like debt, excessive debt taken by a company, and the management has to be very good. That is a very important thing. Other than this, the core product has to be very good. That is a big, risk on and risk off thing. I keep on saying that the core product of any company is the main thing. It gives me a sense of, when you're looking into investing in an Apple computers, so that the core product is strong. So if there is any risk, it can be taken off by the core product. You can, it has the capacity to absorb it because the core product of the company is strong. So you have to look into these things, but definitely risk management is the most important thing when you are into capital markets. I don't know if I've answered you correctly or not, but
no, sir, I completely agree with your point talking about the core product of any company. I completely agree. And everywhere risk is going to be there. It's how well I try and forecast and plan accordingly is what matters. So moving ahead, I came across these two terms quite recently because of obvious financial management. The term fundamental analysis and technical analysis. These two analyses are two major schools of thought when it comes to approaching the markets. Okay, even though they're quite important, they're completely opposite in terms of understanding. So investors and traders use both of these to research and forecast the future of stock prices. So according to you, which is the best analysis, whether it is fundamental or technical analysis, which is the best to do while buying a stock of a company? And does it change sector-wise? That's my question.
Again, we do not have to choose one of the two. Both of them have different characteristics. Technical analysis is all about stock prices and its history, and fundamental analysis is about the company that is behind a specific stock.
Yes.
So they do not pose a challenge to each other that we have to select. Generally people try to select one of the two, but both of them, if combined together, it makes the research very strong. That first of all, you go and look at the company, and how the company is working. Is the company's market share increasing? Is the company very strong? What is the competitive strength of a company? What is its competitive situation? And after that, if you find that that it is a very good company, see, a good company, a good investment includes two things: a good company and a good price at a good price. That is very important. Even if it is a good company, it doesn't mean that it is okay to buy it at an infinite price. Even if you talk about like something like an iPhone, if they start charging like 10 lakh rupees for one iPhone, it doesn't make that a bad product, but it will be very, very overvalued in that case. So same goes with companies. A good investment has to be a combination of a good company and a good price. So we can tell that a company is good or not through fundamental analysis. But the right time to buy it, we to make that decision, we use technical analysis, so that we can do the research in a proper manner. So we do not have to select one of those. We should we should try to combine both of them to make better decisions.
Yes, sir, I agree. A combination of both is. So, sir, coming to the second part of this question, does this differ sector-wise, or you suggest for all sectors?
This is the same for all sectors.
Okay, sir. Thank you, sir. So moving ahead, value investing is a strategy for identifying undervalued stocks in a company based on fundamental analysis, as you pointed out. So value investors use financial ratios such as the price to earnings ratio or the debt to equity ratio or even the earnings to growth to discover the undervalued stock.
Okay.
Again, I'm asking you to choose the best one. So which according to you is the best evaluation metric to analyzing a company's stock?
Okay. Out of PE ratio and
PE ratio. So we have only studied about the debt to equity ratio. We were doing the
okay.
EBIT analysis and the EPS, earnings per share. So we have, as of yet, only studied about the debt to equity ratio, and other concepts are very new to us. So could
Okay.
you tell us which do you
See, I
suggest
think
is
the best metric to decide to value a company's stock is the PE ratio, the price to earnings
Okay.
ratio. Yeah, I
Okay.
don't know if you have studied about it, but it is a very good ratio. It tells you that where the company's price stands, a stock's price stands when compared to its earnings. Like for example, a company is making like 1 crore rupees per annum, okay, and there are 10 lakh shares in the market. So per share it is making 10 rupees, okay, and the share price is like for say 50 rupees per share. So the PE ratio will be 5:1, okay. And when we look at the other companies in the same sector, and all of them have a PE ratio of like, some have a PE ratio of 10:1, another company has a PE ratio of 15:1. So now we know that a company with a 5:1 ratio is the least valued, is a very undervalued company in this sector. So P ratio is a good ratio to make this decision. But it is not the only thing that we have to look. Yeah,
Yes,
I'm because you asked for one issue. Yeah.
No, but the best is taking into consideration the PE ratio.
Yeah.
I so want to learn more about this, and I hope to get to learn more in the future.
Sure.
Moving ahead, so we, as this is the last question for the day, and we are currently studying the net present value. This is one of the profitability metrics. Okay, and this is, I think, a part of the modern techniques. There's modern as well as the traditional techniques. So just a few lectures back, ma'am taught us. This is the modern technique, and it has three under it: the net present value, the internal rate of return, as well as the payback period.
Okay.
So, which profitability model among all these three would you use to determine the profitability of a project? So, which is the best one, or
So
the optimum one?
I think the net present value model is a better, I will prefer to use it, because it is somewhat related to the traditional models, and yeah, we use it a lot in stock market valuations too. We try to value companies and their stocks through the dividends which can be, or the other cash flows which can be generated in the future. So yeah, I think that will be a good model to use.
Thank you so much, sir, for taking out time and agreeing to do this with us, and in such a short notice. And all the answers have definitely gave. I hope Krishna will also agree with me. A lot of insight, and yes, make the financial management a subject we want to learn more about in the future. So anything you'd like to end this interview with? Anything to whoever's going to be watching this in the future?
It was a very fun conversation with you too. I did not expect it to be this fun actually. Yeah, but yeah, because we were talking for the first time. So, but yeah, I could not realize that it was suddenly over. So it was good. It was a good experience. Thank you very much.
Thank you so much, sir. Thank you so much, sir.